Do you want to slash your taxes on your W-2 income using real estate? Well, here are 5 strategies that your CPA might not know. I get it. Your CPA probably has told you that you don't get any tax benefit from investing in real estate because your income is too high, because you work too many hours, because you cannot be a real estate professional. Those are things that are told by CPAs all the time. But despite those things, I'm going to be sharing with you 5 strategies that actually could allow you to use real estate to offset taxes from your W-2 income. And at the end, I'm going to give you 3 signs that you can look out for to see if you are working with the right CPA. All right, the first strategy, passive losses. Yes, it is true that if you make too much income and you are not a real estate professional because you have a full-time job, that rental losses that you generate currently are considered passive. But what CPAs don't talk about is the fact that your passive losses don't just disappear. We actually get to carry them forward year after year, and they actually don't expire. Here's the thing, in the future, when you do sell that rental property, guess what? All those passive losses for that property are then freed up to offset all types of income. So if you sold a property and there were passive losses, and let's say there was an overall loss, those losses actually can also offset taxes from your W-2 income in the year of sale. And guess what? This is true even if you were never a real estate professional with respect to your rental properties. Strategy number 2 on how to use rental real estate to offset taxes from your W-2 income is the short-term rental tax loophole. You may have heard about it, but if not, I'm going to give you a quick summary of that. If you're someone who works a W-2 job and you want to invest in short-term rentals as a side hustle, having a vacation rental property where you make money off of, this is a great way for you to be able to use rental tax benefits against W-2 income. Why do we call it a loophole? Because unlike long-term rentals, if you invest in a short-term rental property, you don't have to be a real estate professional to use the tax losses against W-2 income. In fact, we don't care about how many hours you work at your job. We don't care how much income you make. All you have to do is meet material participation hours with respect to your rental properties. There are 7 different ways to qualify, but I'll share the top 3 that are the most common. First, if you earn at least 500 hours being involved in the day-to-day operations of your short-term rental properties, then you can use losses against W-2 and other income. If you can't meet 500 hours, another way to meet material participation is if you have at least 100 hours and no one else has more time than you. So we're looking at the hours of your cleaning crew, repair guys, landscapers. Basically, you have to have more time than they do. The third way to qualify is you have any number of hours, but you have to have more hours than everybody else combined. So effectively, if you're doing most, if not all of the work with respect to your short-term rental, you could also have met material participation requirements and be able to use your short-term rental losses against W-2 and other income. This is one of the reasons why the short-term rental tax loophole is a fan favorite for a lot of our clients who are high-income earners that are in consulting, sales, physicians, and even athletes, celebrities, and social media influencers. It's basically for anyone who still loves what they're doing full-time, but also wants to start building wealth in real estate in the vacation rental space. All right, strategy number 3 on how to use real estate to offset taxes from your W-2 income is boutique hotel investing. This is something that has been becoming more and more popular in recent years because a lot of mom and pop motels are being sold to the newer generation. So there are more ways to create cash flow with smaller boutique hotels. Similar to the short-term rental tax loophole, hotels are treated differently than long-term rental properties, which means that if you still have a full-time job and you're investing in real estate as a side hustle, then boutique hotel investing could also allow you to use a lot of these same tax benefits to offset taxes from W-2 income. So we think of it sort of like the cousin to the short-term rental tax loophole. A little bit more work, of course, when you invest in boutique hotels potentially, but boutique hotels also give you the ability to scale faster as well. The 4th way to use rental real estate to offset taxes from your W-2 income is to marry a real estate professional. If you're single, maybe consider dating somebody who loves real estate. Or if you are married, take a look at whether one of you should reduce or stop working and spend more time building your real estate portfolio. This is what we refer to as the marriage tax loophole for real estate investors. Effectively, as long as one of you can meet real estate professional status, then both of you can get the tax benefits. So for example, if you're a high-income earner and your spouse or you will be married to someone who is a real estate professional, then your rental losses can offset W-2 and all types of income simply because one of you is a real estate professional. Now, why do we talk about having that second person be a real estate professional? Because for a real estate professional, one of the requirements is that you have to have more time in real estate than your job. And so if you are a single person, you're working full-time, it's going to be difficult for you to have more hours in real estate than your full-time job. And that's why having a second person will really help to utilize this strategy, because again, only one of you needs to qualify. Both of you can get the benefits. All right, the fifth way to use real estate to offset taxes from your W-2 income is with charitable planning. So this is really great for someone who's a high net worth individual, or if you're someone who's very charitable minded. There are many different ways to work this strategy, but one example could be that you buy a rental property and you put the property into a charitable trust. When the property is inside the trust, then you can pledge to donate the future cash flow to the charities of your choice. In exchange for that pledged donation of future income, guess what? You can take an immediate tax deduction this year at a discounted present value. That deduction is a charitable donation deduction, which is why it offsets all types of income, including W-2 and other income. What I love most about charitable planning is that there are ways you can structure it so that in the future, after the end of the trust term, the property actually comes back to you, so that's available for you, your family, as well as your beneficiaries. So as you can see, real estate can provide tax benefits to W-2 income earners. And this is true regardless of how much money you make or how much time you spend in your real estate activities. So the next time your CPA tells you there is no tax benefit for real estate because you're not doing real estate full time, then you can share these tips with them so they can help you look into whether any of these are applicable. Here are 3 signs that you might not be working with the right CPA. The first one that you talked about, right? All they do is focus on how much money do you make, how many hours are you spending in real estate, and the fact that you cannot use real estate to offset taxes from W-2 income today. Because when we talk about tax planning, we're not just talking about this month, this year, or today, we're talking about multi-year, right? Even if it doesn't help me reduce taxes this year, what can it help me do in the future? The second warning sign that you might not be working with the right CPA is that they're not asking you powerful questions. So if you find yourself always asking them questions, can I write this off? Can I do this? Can I pay my kids? Then that is also a sign you're not working with the right CPA. Just like when you go to a doctor, when they ask you all the questions to diagnose a problem, the same should be done with your CPA. So if you're working with someone good, they're the ones asking your questions. How are you trying to build wealth? How many rentals are you trying to acquire? What is your exit strategy? How do you plan to retire? That's a sign of a good CPA rather than someone who's just answering your questions. And the third warning sign that you might not be working with the right CPA is they're basically MIA. How many times have you tried to contact your CPA just to not get any response, right? No email response, no phone call response, because they've basically left for the summer after tax deadline. This is super important because tax planning happens all year round, so make sure you're working with someone who is available when you need help the most. If any of the things that I said was new to you, or if you're just looking for ways to save on taxes for yourself, check out the description below to access my tax savings toolkit. And don't forget to like and subscribe for additional tax strategies.